Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of LME 3-month lead and tin. I'll start with LME 3-month lead. So, it is once again a great comfort to me, even after the falls, rises and now the recent falls once again, that this market is still kept within the broken May to October 2020 bullish shift pitchfork that was originally drawn, well, now easily over a year ago. To recap some of the recent significant actions, late September saw a halt to a decline, stopped dead by the lower time, currently 2162 of this same broken May to October 2020 bullish shift pitchfork. The halt was actually a team effort made from the combination of the lower time plus the slowly rising long moving average, currently 2207, and the big 50% Fibonacci lines of the March to August move at 2160, plus the February 2018 to March 2020 move at 2128. The market consolidated and in early October started to rise back up again, through the middle time, currently at 2332, and all the way to the upper time, currently 2502, where it peaked 5 weeks ago, caught in some congestion between 2443 and 2449, as well as the upper time. This was the peak and the end of the previously oft-mentioned diving board pattern. Since then, we've had a topping action. Initially, it was within a small bear channel that petered out 3 weeks ago, caused by the combination of the same solid-looking, very slowly rising, long-moving average, currently 2207, and the key 50% Fibonacci line on the June to October 2018 move at 2221. Now, don't get me wrong. The 50% Fibonacci line at 2221 is a legitimate support and a good one. However, how strong would you imagine it would have been without the help of that nearby slowly rising long moving average just below? Well, I can tell you. As since then we've dipped back down late last week and at the start of this week, down through this 50% Fibonacci line, and the market has now been halted by the long moving average, with the additional help of the March to October 50% Fibonacci line at 2180. Prices have most recently pulled back up through the nascent late October to date downtrend, currently at 2279, as well as the overhead resistance of the short medium moving average, currently 2284, and the medium moving average, currently 2284 also. These last two moving averages had capped the rise seen back at the start of last week. Well, it looks like that currently seem unable to do so now, as yesterday saw the first close back up over both moving averages, though today is a bit sort of insecure. The thing to watch out for now is again the overhead rising middle time, currently 2332, and if the market gets there and what it does should it get there. It's worthwhile remembering this one key factor. This broken May to October 2020 bullish shift pitchfork is still a bullish shift pitchfork, and until that is truly destroyed, then it will guide this market higher all the while. LME 3-month tin. Look, I'm sorry if you've heard this bit before, but it is so necessary, I'm afraid. So here goes again. I've been repeating this again and again for months and months now. Okay, the overall bullish incentive is still alive and well and strong here. This was and is because of the original move up within the January to March bullish shift pitchfork that started back in March and then translated to a higher level in April, resulting in prices moving up over the middle time, currently 38,320 of the January to March bullish shift pitchfork. Prices even managed to reach up and over the upper time above, currently at 4,700. Back in July, August and mid-October, and as recently as mid-November. Yet in all that time, the market has always come back within the folds of this same bullish pitchfork, as it did back in late November. In all the time since March, this bullish pitchfork had and still has driven prices higher. Now, admittedly, I, and I'm sure you as well, believe that no market can head in one direction all of the time forever, though this metal is giving a pretty good impression of such a market. This is why we saw major corrections back in August, in late September, most recently late October. Yet it is important to note that despite these corrections, the market in all its pullbacks down has never, ever managed to break this same bullish incentive. That's been seen here since March. The evidence for this can be seen by how this market is still today well within the bullish shift pitch fall, currently in between the middle time below, that's currently at 38,320, and the upper time above, currently 4,700. Another point to note, and this may become very important, is if the lower time, currently at 35,475, is challenged, then one should take into account is that the lower time has been married to its long-term partner, the rising medium moving average, currently 35,880, since at least August. Now, it may well be that if we see a separation of these two, between the lower time and this medium moving average, then, perhaps, only then, may we start looking at the bullish incentive as maybe finishing? This is no more than a conjecture on my part this time, but it does have a certain symmetry to it. So I suggest special attention to those two. This brings me once again to my final point, the same final point which I have now repeated from previous commentaries many, many times. It is this, and I quote, "It can be hellish to rely on only one pattern because it can be hellish when it breaks." End of quote. So that's it. That is where we are now, once again. Thank you for listening. This weekly broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.